Hello everyone, my name is Drupin and in this video we will take a look on investing method of Peter Lynch. Note that this video is a short description of Peter Lynch's book One Up on Wall Street and by no means it can justify his original work. I will try my best to explain his work in short, but you are requested to read his book because no YouTube video can really do any justice to Lynch's original work. As per Lynch, first rule of investing is to stop listening to experts because in stock market there are no experts. An average investor considers himself as dumb money whereas expert as smart money. But while investing, smart money isn't that smart and dumb money isn't as dumb as it thinks. Dumb money is only dumb when it listens to smart money. Dumb money can outperform smart money just by doing little research. Dumb money should not listen to smart money because first, smart money can be wrong and second, you will never know smart money changed his mind about stock. As investor, you should have better source of information than expert. As per Lynch, a business is successful if its products are getting popular in customer or products of business are necessary for day-to-day life activities. This provides an amateur investor ability to pick winners of tomorrow just by paying little attention to what's happening at workplace, malls, auto showrooms or restaurant. As customer of product, an amateur investor finds good stocks a lot before any industry expert. This is what he called a street lag. All good businesses start small and they start in your local area. And as customer of that business, you will find its stocks a lot before than any expert. If product becomes popular without brand name recognition based on customer recommendation, imagine how well it will sell when it will get brand recognition. To figure out this simple logic, you don't need a honors degree in business. As per Lynch, maximum education that you need to invest successfully is 4th grade mathematics. Next, you need to invest in what you can understand. As an example, he explains people working in aerospace business invest in auto industry, whereas people who work in computer industry invest in entertainment industry. You already know industry you work with better than any other industry. Invest in industry you can understand. If you work for auto industry, then invest in auto industry. Your chances of winning in your own industry are higher because you understand it. It is your area of competence. Do not take grass is always greener on other side approach. It is deceiving. People invest in businesses that they are totally ignorant about and then they cry on losses. Remember, if any changes happen to your industry, you will be the very first to find about that change than anyone else. This is your edge while investing. All you need to pay is little attention. Lack of attention kills your opportunity to invest. For example, the guy who installed internet at my home and office is using D-Link products since he started his net connection lease business. He was using product from same company in year 2010 and in year 2017 he is still using it. In year 2013-2014 D-Link was trading between 20 to 30 rupees. In July 2015 D-Link made its lifetime high of 251 rupees. For years he walked with a profitable stock in his hand and he failed to invest in it. Same thing also happened with me. As investor, one of my regret was missing buying V-Guard. I knew about V-Guard from time it was trading for 16 rupees. They bought place for their warehouse near our first paint and cement storage facility. They even installed a very big red board with V-Guard written on it. Every day I could see it. I also knew they are South Indian company. But just because I wasn't alert enough, I failed to see South Indian business buying warehouse in Nagpur is kind of very big expansion move. Today it trades like 200 rupees and remains as one of the biggest regret for everyone who knew about it as I did. As per Lynch, market cannot be predicted. Therefore, invest what you can afford to lose without that loss having any effect on your daily life in foreseeable future. Next thing to keep in mind is that market index no longer shows true picture of market. On other hand, advanced decline numbers paint a realistic picture. He also tells us you don't need to make money on every stock you pick. Your losses are limited to amount you invest, whereas your profits have no limits. You need one big win to make money out of 11. The more right you are about one stock, the more you can afford to take risk of being wrong on all other stocks and still end up with big profit. Size of win matters more than number of wins. Also keep in mind, just because your stock is moving slowly while other person's stock is moving fast does not mean you were wrong and other person was right. It simply is unpredictability of market at work. Sometimes you may find business is performing every year and still stock keeps falling. But for time you know business is performing, you should not lose hope. Here's the best thing that you can learn from Lynch in his own words. Sometimes it takes years for stock to catch up to company's value, and the down periods last so long that investors begin to doubt that will ever happen. But value always wins out, or at least in enough number of cases that it's worthwhile to believe it. If business is good and you are holding its stocks, it's very likely you will never know when prices will catch up to the value business deserves. But if you will sell even after business is performing day in and day out, price move becomes predictable. Most likely upside is very near, or it starts just the very next day you decide to sell. For time business is performing, do not let waiting time make you take foolish decision. A typical stock in Lynch portfolio usually takes 3 to 10 years to play out well, and you need patience to hold good business for that amount of time. Lynch divided companies in 6 different categories. According to him, while investing you must have very good reason why you are investing in particular category. Investment in each category have its own advantages and disadvantages. First are slow growers. These are large and aging companies that are expected to grow slower than gross national product of country. They start as fast growers and eventually run out of gas. Yearly growth rate is usually less than 10%. All fast growing companies sooner or later become slow growers. Slow growers in spite of slow growth offers generous dividends. Second are stalwarts. These are multi-billion-dollar industries that grow little faster than slow grower. They grow mostly by 10 to 12% every year. Depending on when you buy it, you can make sizable profit in them. Annually, you cannot expect more than 30 to 50% profit in them. 30 to 50 profit is maximum that you should expect from them. Stalwarts are usually bought to provide your portfolio protection against recession. Stalwarts suffer least during hard times of market. Next are fast growers. These are everyone's favorite investments. These are businesses that grow at rate of 20 to 25% every year, pushing their stock prices to new highs. These are the stocks with help of which a career as investor is made. Keep in mind, a fast grower can belong to any industry. It is not a requirement that fast growers should belong to fast growing industry. They are small but aggressive businesses with lot of financial load for growth, which makes them risky investments. But profits they deliver are worth risk you will take on them. Fourth are cyclical. These are businesses whose profits rise and fall in regular fashion based on market condition. Auto, airlines, steel, tires and chemical industries can be classified as cyclical. If invested at right time, these stocks can deliver results very fast. By the way, in case you are wrong, they can eat your investments as fast as they deliver profit. Fifth are turnarounds. These are businesses that got beat by their own wrong decisions. Their financial status is broken and they are deteriorating as business. The good thing about investing in turnaround business is that they move independent to market direction. Successful turnaround pushes business into growth phase, thus helping you pocket massive profits on small investments. The final on list are asset plays. These are businesses that are sitting with very valuable assets. Mostly these assets are underrepresented on financial data of business. These assets can be simple pile of cash, real estate or investments. Growth rate of asset plays do not matter. What matters is value of asset they are sitting on. You buy their stocks and wait for market to recognize true value of their underrepresented asset. Asset plays see sudden increase in stock prices as soon as true value of their asset gets revealed to investor. Prices start moving up very fast, delivering quick multi-bagger gains. As per Lynch, a perfect company is easy to understand. Running that company should be simple task. He writes, if someone says any idiot can run this business, then that's good sign because sooner or later an idiot will surely run it. Lynch put forward some methods to find a perfect deal company. According to him, a perfect company have a dull, boring or ridiculous name. They do something so dull that you might hardly hear their names on television, newspaper or magazines. Sometimes these companies do something so disgusting that institutions don't like to own them. As an example, he mentions about Safety Clean Company. They used to provide gas station service of removing grease from auto parts. That might sound little disgusting, but absolutely everyone who owns motor vehicle needs that service. With growing numbers of automobiles every single day, it is practically impossible for them to not flourish if management is good. A more disgusting is Solid and Toxic Waste Management Company. You might not like the dirty work, but almost every human being on planet produces them every single day. It is also impossible for them to go out of business. People also dislike owning shares of businesses that do something depressing. To illustrate his point, he provided example of a funeral service business. In stock market, company's name and its work can be deceiving to emotion, but most of the time these are logically safe investments. He explains this with several examples. So never judge a company by its name and work. He also mentions a business that hasn't got institutional attention is best to invest. Stocks get institutional attention only after they hit at least two-figure mark. Usually a perfect deal can be found in non-growth industry, and sometimes they can also be spin-off businesses. For example, suppose Jaiswal Juice Industries manufactures all type of fruit beverages, but their orange beverages start bringing in more money. So they decide to let orange sector of their business to become independent standalone business. So orange sector is separated from Jaiswal Juice Industries to Jaiswal Orange Products. Here we can say that Jaiswal Orange Product is spin-off of Jaiswal Juice Industries. Here Jaiswal Juice Industry is parent company to Jaiswal Orange Products. A child company may or may not have to share its earning with parent company. In case child shares its profit with parent company, we say its earnings are diluted. Good businesses usually manufactures products that customer have to keep buying. They target specific niche in market and they focus more on use of technology than creating a new one. A good business is flourishing business, therefore not only insiders of business but business itself is also buying back its share. As per Lynch, you should always avoid the hottest stock in industry, and the reason is hot stocks goes up fast. It may happen the time you would buy, you would not be able to reap profits because it might have already matched the required market valuation. You should also avoid stocks that are advertised with exciting names. In Fundamental Investing Basics video, we learned about exposure effect. Though Lynch didn't use term exposure effect, but he pretty much summed up the same thing. Note that the first print of One Up on Wall Street was published in 1989 and investing psychology as subject came into study in after years of 1990, most likely gained popularity after 1995 to 2000 calendar year. Inspired of that, Peter Lynch has summed up pretty much everything about investing psychology a lot before subject was actually introduced. When you will go from his book, you can't avoid marveling about his intelligence. It seems like he learned from his every single mistake and made sure not to make them again. It is not surprising at all that during his last 5 years, Fidelity Magellan outperformed almost all stock funds by 99%, making it biggest stock fund management of their time. He also advised to avoid whisper stock and stocks that is getting called next Reliance, next MRF. Whisper stocks are those stocks about which you get spammed now and then via SMS, email or phone calls. Finally, he also advised to avoid stocks that are aggressively overtaking other businesses which are not in their area of competence. For example, suppose Jaiswal Juice Industries is aggressively overtaking auto ancillary companies just for sake of diversification. In case diversification outside comfort zone is done slowly by overtaking one business at a time, you should wait to see can they really diversify outside their comfort zone. If yes, then there is no reason to avoid that stock. Note that Lynch gave rules to invest in all 6 categories of business, but we can't cover all of them in one video. So we will take a look on that kind of business that would typically qualify to be in Lynch's portfolio. As per Lynch, a business can be analyzed based on its growth valuation, debt valuation and cash valuation. The first thing to consider in growth valuation include how much does popular product contribute to overall sales of business. For example, he explains Lexan Plastics was popular product by General Electrics, but Lexan only contributed to only 6% of sales for General Electrics. Even if Lexan Plastics sales doubles in a year, it wouldn't really add any major profit in total revenue. So first thing that you should find out is how much does popular product contributes to overall sales revenue of business. You can find that in annual report of business. If popular product is major contributor to revenue, then it qualifies for first condition for growth valuation. Next on list for growth valuation is earning growth rate of business. To calculate EGR, divide current year's profit after tax by previous year's profit after tax and raise its power to 1 by R, where R stands for number of years passed between current and previous PAT. For example, let's take a look on Uflex. On 2017, PAT is 193.55 crore and on 2014, PAT is 129.36 crore. To get EGR between 2014 to 2017, we divide 193.55 by 129.36, raise its power by 1 by 3 since we are calculating earning growth rate for 3 years, and finally negate 1 from it. Our answer is 0.1437. Convert it to percentage and we will get 14.37 as earning growth rate from year 2014 to 2017. As per Lynch, slow growers EGR is 3 to 5% each year, stalwarts EGR is 10 to 12%, whereas fast growers EGR is 25 or above. Uflex qualifies as stalwart since its EGR is 14. By the way, when Lynch wrote his book, profit margins would not fluctuate as regularly as they do today. So my advice would be, rather than just calculating EGR, use same formula to calculate net sales growth rate. Now take average of EGR and net sales growth rate and compare it to categories. In this case, net sales growth rate is 7.66. So if we take average, we will get 11.02. So Uflex still qualifies as stalwart with respect to new EGR. Next, he asked to take a look on PE ratio. Lynch explains PE is numerical shorthand for the relationship between the stock and the earning of the company. He also mentions traditional approach to PE as number of years it will take the company to earn back the initial amount you invested in it. But he also wants earning as well as prices of business rarely remain constant. Next, PE for different industries differ. So PE is also a relative number. Looking for just low PE is very deceiving in nature and makes no sense at all since you cannot compare apples to oranges. What's bargain for chemical industry isn't necessarily means bargain for software industry. The best approach you can take to make decision based on PE is to track history of PE for several years for stock as well as its industry. A company with high PE must have incredible earnings to justify high price of stock. Market index and industry index as whole also have their collective PE ratio, which can also serve as good indicator whether the stock in question is undervalued or overvalued. If EGR by PE results in value equal to or greater than 1, then it qualifies as stock trading for bargain price. For example, right now on 31st August 2017, Uflex is trading at 436 and have PE of 9. We already calculated EGR as 11. So 11 by 9 equals 1.2. Since we got value above 1, Uflex also qualifies as stock available for bargain price. Next, he asked to take a look on book value. He states people invest in stocks on theory that if book value is $20 and stock sells for $10, they are getting something for half price. The flaw is that the stated book value often bears little relationship to the actual value of company. So if you are buying a stock based on book value, you must have detailed understanding of what that value means. By the way, if earning of company is increasing, most likely its book value will also increase. So if stock matches all previous conditions, it should also match increase in book value. If a business pays dividend along with everything we discussed before, then you have a very strong reason to buy it. First is that most businesses that don't pay dividends have sorry history of blowing up money on string of stupid plans. Next, dividend paying stocks show higher resistance to fall in price. By the way, small companies that don't pay dividends are likely to grow at much faster rate because of it. So while making decision on dividends, you have to consider size of business you are buying. Note that dividend condition should be taken as added benefit, not as required condition. You too can buy business which do not pay dividends. Finally, as growth valuation, he recommends to take a look on bottom line. Bottom line is nothing but profit after tax. You should also take a look on profit margin of business. Note that profit margins are industry specific. You cannot expect profit margin of steel industry to match pharmaceutical industry. Also, the company with highest profit margin is by definition is lowest cost producer. And low cost producer has better chance of surviving bad market conditions. For example, Uflex have consistent net profit margin of 5% since last several years. I also checked few other stocks in packaging sector and some of them are operating at profit margin at least thrice of Uflex. But most of them aren't really available for bargain price, so Uflex was my best choice. On other hand, I believe non-fluctuating profit margins are equally good as high profit margins. For debt valuations, Lynch preferred debt to equity ratio of 0.25. Honestly, this kind of debt to equity ratio is very difficult nowadays. If you can find such stock, then you are one lucky guy. By the way, I would advise to learn about business debt in case you don't want to miss good businesses just because they do not match 0.25 debt to equity ratio. Final thing to look in business is its cash valuation. First thing to look in cash valuation is cash flow. Lynch described cash flow as amount of money a company takes in as a result of doing business. A business spends this money to operate business activities. Some spend more while others spend less. Lynch advised to invest in businesses that do not depend a lot on capital spending. He would prefer stocks in which business would make profit of at least 10% on cash flow. A consistency of 10% or above return on cash flow would qualify as a long-term investment. For example, take a look on cash flow statement of Uflex. Well, I will not go in detail explaining everything on cash flow statement, just few important details that you should know. Operating activities are cash that came inside business by selling of goods and services. Financing activities are cash that came inside business by selling debt instruments like bonds and stocks. Investing activities are cash that went out of business as spending to keep business running. Increase and decrease is addition of all activities. But the number that we are interested in is cash and cash equivalent at the end of the year. This is the number that should grow by at least 10% every year with consistency, which as you can see is not the case with Uflex. On the other hand, if we take a look on Whirlpool cash flow, cash and cash equivalents at end of year has increased every year. Personally, while analysis, I don't give any special importance to cash flow statement, therefore Uflex is in my portfolio. It matches what conditions I usually prefer to see in my stocks. In case you can understand nature of different businesses, then you should take a look on their inventories too. Note that if you can understand business, then and only then you should take a look on inventories. It is deceiving number in case you don't know the nature of business. Finally, as cash valuation, if business owns any hidden asset, then that's gold plating on silver plate. Lynch makes it very clear that he does not time market for buying and selling. If fundamentals are good, then stock is worth buying. By the way, if you are looking for a good bargain, then there are two scenarios where if you can muster enough logic and courage, you could get good bargain. During festive and tax season, people usually sell their stocks and prices fall down. You can pick several good stock during this time for good bargain. Next, every now and then market suffers collapse or you can say free fall. Those times most stocks become undervalued. Buy in case you have presence of mind to figure out as per PE versus price history, the stock has become undervalued. Lynch says there isn't standard formula that he uses to sell, but in majority of cases he sells only when he finds other business that have higher potential of performance than stock he is holding right now, or the reason for which he bought stock no longer exists. He says if you know why you have bought some stock at first place, then you shouldn't have problem figuring out when to sell it. If you know a stock with EGR of 15 and PE of 9 is undervalued, you don't have to be genius to figure out when stock will start showing EGR below 15 but PE lot above 15. the price is stretching too far. In such cases, prices can fall sooner or later. If EGR fails to keep up with increasing PE, it's time to sell. Lynch haven't given any specific preference, either you should have a concentrated or over-diversified portfolio. On the other hand, he stated he have over-diversified portfolio with over 1,400 stocks in it. Lynch's method for long-term investing is really simple and absolutely anyone can use it. The problem is that most people just don't realize that common sense investing really depends on investor. Though you will find One Up on Wall Street smaller than other books on investing, still it is packed with maximum information. There were a lot of things that were not covered in this video because of time, so my advice would be to read his book for better understanding of his work. With that said, thanks for watching this video and have a nice day.